Hello and welcome to CNBC TV18. I'm Sumaira Abidi and you're watching MF Corner. On the show today, we'll connect with Prableen Bajpai of FinFix Research to talk about passive strategies beyond large caps. And a little later, we'll catch up with Santosh Joseph of Germinate Investor Services to talk about how market corrections can actually turn out to be an investor's best friend. So first up, let me invite Prableen Bajpai. Hi, Prableen. Thanks very much for joining in. So today, let's talk about the mid-cap space, right? And what are the kind of passive strategies available there? But before we talk about that, you want to know, what are the various indices available and how they can be differentiated?
Right. Good afternoon, Sumaira, to you and all your viewers. Passives are still a newer segment when it comes to the mid-cap space. In terms of AUM, Sumaira, it's just about, the schemes are just about 1,700 crores as opposed to the mid-cap segment, the active category, which is about 1,62,000 crores. So it's a newer segment. We have 11 schemes here, and they are broadly tracking three indices, which are the Nifty Mid-Cap 150, Nifty Mid-Cap 50 and Nifty Mid-Cap 150 Quality 50. So I'll just take you through each one of them. The first one being, Sumaira, it's the Mid-Cap Nifty 150 index. And this broadly represents the whole mid-cap space because it's the 101st till the 250th company which is listed on the exchange. So the whole 17 to 18% of the market cap, which is represented by the mid-caps, is right here. Because of the number of stocks which are there in this index, the concentration risk is low. It's about 18%. And the way these stocks are picked for this index is that the average of 6 months full market capitalization is seen, and then the free float of these companies is checked and the weightage is given. The top few scripts here, Sumaira, are Adani, they are Tata Power, AU Small Finance. And I think this is a very good broad-based index available to investors, which majority schemes tracking this particular index. So there are 7 schemes, out of which 5 are index funds and 2 are ETFs, which are tracking the Nifty Midcap 150. Next comes the Nifty Midcap 50, which is a smaller segment. So it's a subset of this broader index. And here, there is one differentiation that other than the market cap that they see for inclusion of these 50 companies, all these 50 companies, which are now part of the mid-cap 50, also need to have their trading in the FNO. So they have to have the derivative contracts as well. The percentage allocation, of course, because the number of stocks is less in this index, goes up to about 34%. And there are 2 strategies, Sumaira, which are tracking these. One is the Kotak ETF Midcap 50, and the other one is an index fund by Axis. These 2 are tracking the Midcap 50. And we have another variation, which is a strategy index. So a strategy index is a smart beta strategy, wherein the Midcap 150 is the parent index, but a particular factor is included, and on the basis of that, a score is given. In this particular case, because it's the Midcap 150 Quality 50 index, quality is the criteria which is seen. And how is the quality defined here? It is defined on the basis of return to equity, on the basis of consistency in the earnings per share, as well as how much leverage, financial leverage these companies are holding. And here again, 2 strategies available to investors. One is an ETF by DSP, and the other is the UTI index. And interestingly, this particular index actually has a lower volatility, or let's say the standard deviation amongst all the 3 mid-cap indices available to investors.
Okay. But Prableen, the whole question in terms of performance, or what experts say is that it's okay to have a passive in the large cap space because anyway even the active schemes are index hackers, right? So therefore there is not much by way of performance. But specifically for mid caps, it is said that you need that active fund management because you can pick up stocks which other fund managers may not have found or whatever. So therefore, yes, how is the performance of mid-cap passives when you compare to other indices?
So Sumaira, let's take the as compared to the large cap. So if somebody has to constitute a portfolio, let's say, which is totally passive, and you're looking at the broader large cap indices, and then you want to just combine a mid cap, in comparison to Nifty 50 and Nifty 100, see, 1 year returns, I don't think are very meaningful. So we'll just go to the 5-year returns, which is the compounded returns. Mid-cap 150 and the other two mid-cap indices have actually given equal or more returns than the large cap indices, and not at a higher volatility. In the mid-cap 150 quality 50 actually has a standard deviation of 16.99 as compared to 18.87 for Nifty 50. And even the mid-cap 150 actually has a standard deviation of just 19 as compared to 18.87 of Nifty. And the returns are absolutely comparable. Compound returns 14.35% for Nifty 50 in the last 5 years. And for the mid-cap indices, it's varying from 14.41 to about 15%. So in terms of a comparison with the large cap counterpart, Sumaira, I think it is wrong to assume that, taking exposure to the mid-cap space through a passive strategy is not good. In the last 10 calendar years, 7 years, the mid-cap index has actually beaten the large cap. But of course, it is not to, these two indices are not in competition. They are complementary to each other, because the mid-cap space is actually able to give the investors who are holding large cap strategies those exposures in terms of sectors which are not available in the large cap space, because they're heavy on financials, they're heavy on IT, and all these sectors are almost half in the mid-cap space. So I think these two together in combination can make a great portfolio for investors.
Okay. And, in terms of active then, how would you compare in terms of returns or outperformance?
Right. So, Sumaira, you just mentioned that in the mid-cap, I think we all assume and are quite firm on the belief that there is a lot of scope for outperformance. But I think that's sadly not the case. Some of the mid-cap funds have performed exceptionally, I think, spectacular performance. But the problem lies in the divergence. So if we see on a 1-year basis, the best performing and the worst performing, the returns are, there's a gap of 33%. The gap reduces to about 18-19% if we see on a 3-year basis, but the gap is still there by about 13.5% on a 5-year basis. So I think one problem in the mid-cap active space is the broad divergence that we have across these schemes, the best performers and the consistent performers in the mid-cap space. Second, Sumaira, there's a report which is issued each year, which is the SPIVA India scorecard. And on the basis of that report, the ending December of 2021, on a 5-year basis, 58% of the mid-cap funds did not beat the index. And on a 10-year basis, 56% did not beat the index. So I think the risk for investors lies in the fund selection. So the fund selection risk for investors in the mid-cap space is very high. And if we look at the rolling returns as well, even then, only 6 funds out of the 21 which have a 5-year plus period have actually given consistently, with consistency, 70% consistency, they've been able to beat the benchmark. So I think the issue lies in, being stuck with the underperformer, and the underperformance is not by 1-2%. It is very, very huge. So, if we just compare the category returns with the index returns, I think it's the problem of lagging the index by a huge margin can totally be avoided. But of course, if somebody has the research capabilities and has guidance, then of course, if he's able to pick or she's able to pick a good mid cap, it still makes sense because the outperformance is there. But I think the problem lies in the fund selection risk.
But does these passive funds have a place in investors' portfolio? I mean, every investor, who should invest in them? And more importantly, what is the reason to choose a passive mid-cap, fund?
Sumaira, even mid-caps is, at the end of the day, it's a 150 stock, sort of a basket from where fund managers have to pick. And given the shrinking alpha generation or the outperformance, 6 funds or 5 funds out of the 20 funds or 26 funds, if we are seeing 8 out of the overall 26 funds have been able to beat the category average on a 5-year basis. So I feel that maybe somebody who has a vision of investing for the next 7 to 10 years, it's okay to go with the active fund. But I think the dynamics in the Indian markets will also change. And for someone who's actually looking at constructing a portfolio for the next 15 and 20 years, I feel going with an index strategy definitely has a lot of merit. It is definitely giving them exposure to the emerging, companies in India which have high growth potential. It's a relatively low cost because the cost here for index or ETFs is ranging from 0.05 to about 0.3%. But for direct funds, active funds, it actually starts from zero point 0.3 and goes up to, Sumit, it goes up high as 2.35%, which is very, very high. So I feel it definitely has place in investors' portfolio where they do not want to get into the whole exercise of researching and looking for that outperformer, and just go want to a simple core strategy. And then I feel the little gap which is there, which can be filled by active management, maybe a large cap fund in the passive, a mid cap fund in the passive space, and then a flexi cap fund, or it can be complemented by a large mid active fund, which can fill those gaps which are not taken care of by these indices.
All right, Prableen, thanks very much for joining in and explaining this. And, we should also take up the passive investing in the small cap space perhaps a little bit later. But thanks very much for explaining this. A quick break. On the other side, we'll talk about something very relevant and timely, which is, how to make the most of market corrections. Santosh Joseph of Germinate Investor Services will join in. Hi, welcome back. You're watching MF Corner. Well, the next topic is very interesting. We have Santosh Joseph of Germinate Investor Services joining in to talk about how market corrections can turn out to be an investor's best friend. Santosh, hi, good afternoon. But, the one question that a lot of people want to know is exactly this: are corrections a threat or an opportunity? And how should investors read this latest round of volatility that we've seen in our own market?
Hi, Sumaira. Good afternoon. For an investor, it's quite obvious that this is a great opportunity, and therefore, I believe a correction of this sort is an investor's best friend into what the outcome of an investor is. Now, we know over the last 5-6 months in particular, since Nifty made an all-time high in October the 13th of 2021, the markets have been rather volatile. Now, whether it was the Omicron, whether it was another fear of another wave that could have come, or the Ukraine war, and now recently inflation. Therefore, for an investor who missed out the opportunity the last 2 years, saying I missed March 2020 of the COVID lows, or I missed May 2021 when we had the very, very bad second wave and markets gave another great opportunity. So therefore, investor is looking for an opportunity where he can get prices lower. Now, what does a low price mean? A correction in the market or high volatility in the market. I think the only positive way to look at such a volatile or a correcting market is that you're able to invest or buy at lower levels and therefore not worry about missing out the opportunity.
Absolutely. And, this year itself, we've seen quite a bit. But, it is said that, don't stand in the way of, falling, or don't try to catch a falling knife. So how do investors differentiate when, the time or when it's okay to buy a dip and when it is time to stay away?
Very good point. And, we say it metamorphically that don't catch a falling knife. But here's an example. On October 2021, the market made a high. And then by the time you came to November end, the market had corrected significantly. Most people were worried and they thought that they're not going to see market recovery. Then by the time you came to Jan, again, Nifty recovered to 18,000. Now, at every point in time, when you buy, when the first drop happens, and you have to buy when the second drop, or you have to buy when the third drop happens, one, you won't have capital to keep buying every time. Two, when you keep on buying, where are you getting the funds from? Are you doing something that messes with your asset allocation? So the important thing is wait for a meaningful correction to happen, number one. Now, especially if you're a long-term investor and if you're not going to be looking at the screen, it's normal these days to see a 10 to 15% volatility over a 1 or 2 month period. And we've seen it between Jan, Feb, March and April itself. We saw markets go up 15%, correct 15%, and now retrace a little bit. So don't jump into buying the first dip. Wait for it. If it's a 5 or 10%, just let it go. It'll recover by itself. If it's large, now also very important thumb rule, you will always know a market bottom or a market correction only in hindsight. So therefore, don't try to preempt, don't try to predict and say, I'll catch it. More or less, you will hurt yourself. Buy if you have the liquidity, buy if you want to reassess your asset allocation, or buy if you have fresh capital coming in and you have monies that you want to buy more into equity. Because like we said, volatility or market correction is investor's best friend to buy more of what you are looking to buy or seeking to buy.
Okay. But, besides just buying, what kind of portfolio changes are ideal during market corrections?
See, it's always important to begin with building a well-balanced or asset allocation in mind. Now, when you see a market correction and if you feel that there's a skew in your asset allocation, then you make those moves, which in turn means you're buying more equity. Now, if even a 10 or 15% correction happens, but then you're happy with the quality of holdings that you have, great, don't touch, don't tinker, let it continue. On the other hand, when the market correction happens, you look at your portfolio, it's like a progress report. You see some very badly destroyed in terms of value and some holding up in value. It's a great time to rethink that from this point on, what could possibly do well, and then maybe slightly reassess or realign your portfolio, having been through what you've gone. So realignment or a corrective action when the market correction is only required if you feel that you're going to do this change and stay good and stay put for a slightly longer period of time. Otherwise, if you're a well-sorted person in terms of asset allocation and the quality of investment, let the market correction pass by. Don't touch your portfolio. It will recover and also go on to do well.
But Santosh, just one more question is if you were to take opportunities, during a market correction, is SIP still the preferred route? Should someone look at STP or maybe even lump sum?
So SIP is forever a good route because you are automating and also buying. So April and May were good months and you're happy that your SIP went in because it went in at a lower NAV and you got a higher number of units. Now, if you have an STP going, you're happy because you have some liquidity, which is already going at predefined intervals. Now, if you want to really feel that you're happy with the correction that you got, you can accelerate the STP or convert that STP into a switch. The third part is if you're waiting on the sideline sidelines for this opportunity, you got it. I mean, you've got almost a 12.5-13% correction right now from the peak that we saw on the first week of April. From the 4th of April, you're sitting at a nice 10-12% off. You can buy right now. If you're someone who's waiting for a slightly bigger correction, maybe you'll have to wait out. If we don't know whether that's going to happen. But I think a 10 to 12% correction is good enough to at least accelerate your STPs.
All right, Santosh, understood. Thanks very much for joining in. So, like with all sorts of behavioral biases, getting nervous when there's a market correction is also just that, a behavioral bias. A market correction is nothing but an opportunity to buy at lower levels. And, it's something unavoidable as well. So, don't let it unnerve you. Continue with your asset allocation and the portfolio that you have. With that, we'll wind up on MF Corner. Do keep sending us your queries or any suggestions for future shows. We'll be very, very happy to take them up. For now, stay tuned. Closing bell is up next.